Good morning from London. I'm Anna Edwards alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. Global stocks in the green as investors await delayed US PCE data. Fed Chair frontrunner Kevin Hassett calls for a cut next week. The yen strengthens against the dollar and JGB futures fall after sources tell Bloomberg that BOJ officials are ready to hike rates this month, providing there is no major shock to the economy before then. And German Chancellor Friedrich Merz's ruling coalition faces a key vote in Parliament on a pension bill today. This as a group of younger lawmakers from his own party may rebel against him.
OK, here we go. It kind of feels like the Friday before next week. There's a lot happening next week, BOJ and the Fed, and it's just been talking about that. So today kind of feels a bit like that. We've been creeping towards fresh record highs in terms of equities stateside. S&P futures, pretty similar picture over here on this side of the Atlantic, up kind of 2.3% is the broader picture. This is the thing I think you need to pay attention to next week. If there's a surprise coming next week, does it come from the Fed or does it come from the BOJ? If the BOJ raises rates and is hawkish, that feels like it could be potentially a bigger shock to markets. Keep an eye on what is happening with dollar yen right now. And copper continues to push ever higher. I think Citi is the latest one talking about this push continuing. What is interesting is that commodities are moving higher. Break-evens aren't showing much inflation yet. Does that start to change? Copper trading up nearly 2%. Plenty to talk about. The countdown to the opening trade starts right now. Friday the 5th, good morning. We've got a lot on the agenda this morning, but I think it's all mainly focused on what happens next week. Today's going to be interesting. Next week is going to be fascinating. You've got the Fed. Hassett says 25. He's the new Fed chair, it seems. Maybe we should listen to him. Not quite yet, but getting there. And we've got the BOJ. And I just wonder which one of these two things is going to provide the biggest shock. Which one of these central bank meetings is going to provide the biggest surprise for the market next week? Yeah,
absolutely. We have to wait a little bit longer for the BOJ than the Fed, but we'll see which, where these surprises as we go through December, where they come from. The PCE data is going to be interesting today. That's where the market is focused in the very short term. But you're right, we do feel that we're setting ourselves up for next week. And so the lens we apply to the PCE, it's delayed, it's September, it's pretty old. But does it provide any reason not to cut rates next week? Would seem to be the question that the market is going to be asking around the PCE data. And the words that Bloomberg Economics are using is that it's probably going to just fizzle. It's elevated, but it'll just fizzle, which they suggest means it's not going anywhere very fast, which doesn't sound like the kind of data point that's going to stand in the way of a cut.
But the kind of it's this flow of news in front of the BOJ, which I think is fascinating. It's not next week; it's the week after. I appreciate that, but it's kind of this build-up, and I'm just kind of wondering where ultimately financial markets are going to react as we build towards these two meetings. The BOJ has been this kind of huge source of really interesting liquidity for global markets. The Fed, I think, is obviously the one that's been driving markets more recently. And the rally we've seen, Dan was pointing this out to me a few minutes ago, the rally we've seen in small caps and all kinds of other assets has been largely hinged on this idea that the Fed is going to be cutting by 25 basis points. But if the Fed is hawkish, is that a bigger surprise? Or the following week, if the BOJ is hawkish, or the week after that, is the kind of the bigger surprise? Where does it come from? This kind of drumbeat towards the BOJ, I think, is kind of next week through. It's going to be really interesting.
Yes, and we might not get a resolution to who leads the Fed, and would that be a surprise? That does seem to be that the market is setting itself up for it to be Hassett. I mean, that's a lot of the chatter, at least, and a lot of our reporting suggests that he is the person, and President Trump seems to have nodded towards that. But, we don't count anything as a fact until it is, and so we'll wait and see what happens there. Now, we've talked a bit about the BOJ. Let's dive into that in a bit more detail, shall we, Guy? Because our reporting then is suggesting that our sources saying that the BOJ is ready to raise interest rates if there is no major shock. We have to wait until the 19th of December for this meeting to take place. And so, there is time for a shock before the 19th of December, and there is often volatility around the BOJ just ahead of Christmas. But it's interesting that our reporting also suggests that they are going to indicate that they are ready to hike more.
So that's the bit that I think is really interesting, and that's what I mean about this kind of drumbeat and where the shock comes from. If that language continues, that is a big change, because that tells you that potentially Japanese yields can go higher. Japanese yields that have been suppressed for so long can normalise further. And Japanese investors, this huge pool of savings that exists in Japan, maybe doesn't spend quite as much time looking at the United States and Europe. It maybe spends more time thinking about how it's going to invest domestically. And that liquidity story, which has been so important for global markets, maybe starts to peter out.
Yes, and I wonder when that kicks in, you know, what rate is high enough to attract that money back to Japan? Is it just a question of interest rate differentials between the BOJ and the Fed, or is it more complicated than that? Interesting to think about the politics, because just a week ago, we were only 60% sure that we were going to get a hike in December from the BOJ.
Yep.
Now we seem to be 90% sure. So things have moved a huge distance in just a week. To your point about whether we get a hawkish hike, that would be another move again. And in the context of the politics and whether we get any pushback from politicians on that could get interesting.
The new government appears okay to, and appears to be on board with at least this one hike that's coming through. But the volatility building up to this meeting, I think, is going to be... the language is still being couched in terms of things can change. And you kind of look at the Fed and you think, I think... maybe Powell surprise. There is the potential for a Powell surprise, but it feels that I'm going to be more on tenterhooks now waiting for a BOJ surprise than a Powell surprise. And I'm just wondering if that's what maybe starts to move things around a little bit as we head in towards Christmas. Liquidity starts to lighten up. That's potentially where the shock comes from. Germany. Yes,
let's talk about Germany, because this is a story that sort of crept up on me at the beginning of the week and now is sort of bubbling away in the background. It might be nothing to see here by the end of today, but it might be something that lingers on. So we've got 7-month-old coalition that is potentially at risk from this pension vote today. Not because the pension vote won't pass. It does seem as if, according to our reporting, that the pension vote will probably pass, even if members of his own party don't all vote with him. In particular, younger members of his party don't vote with him. But in a sense, that is the point. That tells us something interesting about his power base, about his ability to deliver the policy agenda. And that policy of fiscal stimulus in Germany around infrastructure, around defence, is so important for Europe right now.
But don't you think the genesis of this is interesting? In as much as this is younger members of Merz's party basically saying, don't raise pensions, don't spend even more on pensions at a time when we need to spend money elsewhere. And it's the younger cohort that is pushing back on this huge pension spending that is happening. And that has a reflection in what's happening in France. And it also has a reflection on what's happening here. This whole question around how you bring down social security in the UK is basically now increasingly centred around the idea of the triple lock. And this is going to be a problem for Europe. And the fact that Merz is experiencing it so early in his premiership, I think, is fascinating.
Yes, and so this has wider read across then, doesn't it, to other parts of Europe, as you say. There are plenty of other countries struggling with tough demographics and how you deal with that. Increasingly, this will be a point we're talking about, the younger generation and their take on what's being provided for the older. The extra dimension in the German context is that the AfD is now leading in a lot of the opinion polls. And so that is something that clearly will be in the minds of anybody who is thinking about either rebelling against their party, wherever their party line on this, or falling into line. And that, the prospect of collapsing the coalition will be in their minds as they make those decisions.
So that's why Die Linke looks like it's going to potentially abstain, which could change the arithmetic within the Bundestag. And again, it's interesting that it's the left, this kind of old Eastern European anti-capitalist kind of roots in Eastern Europe that potentially is going to be voting or not voting in this process to change the arithmetic within the Bundestag.
And so if you're a CDU leader of this coalition, that's not necessarily something that makes you look strong and in control of the agenda. So that's certainly something we'll watch. Yep,
busy day coming up, a busy week coming up next week. Fed versus BOJ, which one are you going to be focusing on? We've got all of that covered today. Naomi Fink is going to be joining us, Amova Asset Management Chief Strategist, joining us very shortly. Pooja Kumra, TD Securities Senior European and UK Rate Strategist, joining us as well. There's a lot going on at the front end of the curve. Pay attention. Beata Manthey, Citi European Equity Strategy Head, joining us. And Jose Manuel Campa, the European Banking Authority Chair, joining us in the second hour.
Lots to talk about then with our guests in the programme. Some of the things still on our agenda. We've talked about a couple of things. We've talked about US PCE. That is still due at 3 o'clock UK time. That comes. So that's delayed September PCE. We'll also get UMISH sentiment. So a nice take on the US consumer, perhaps. And we get this pension vote in Germany. I think that is going to be crucial because even if it gets through, as we've said, there's a lot in the politics and the detail.
Noon UK time, 1 p.m. Berlin time, I think, is when we're going to get the results of that. What else do you need to know this Friday morning? Stellantis is touting promising signs of a turnaround at its Ram and Jeep brands after adding more powerful engines and new hybrid options. In comments at a Goldman Sachs conference, the CEO, Antonio Filosa, said the group received, get this, 50,000 orders for Ram pickups with the Hemi V8 engine. Pretty powerful engine, within 6 weeks of bringing that powertrain back online as an option for customers. Filosa also added there's also been huge, quote, huge interest for the new hybrid Jeep Cherokee and for combustion engines powering Dodge muscle cars. Like, muscle cars and combustion engines kind of go hand in hand in my mind. Anyway, Blue Owl Capital has raised $1.7 billion for its latest digital infrastructure fund. Its digital infrastructure trust also picked up interest in 11 US data centers from affiliated entities in a deal valued at $1.5 billion. The firm is making an aggressive push into the space, providing more than $50 billion in data center financing to Meta and Oracle. And Bloomberg has learned that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and HBO Max streaming services to Netflix. Sources say that Netflix is offering a $5 billion breakup fee if regulators don't approve the deal, and the two companies could announce the deal over the coming days. Are they going to be able to win an Oscar, is my question.
That's your question. I wonder, do they care more about winning an Oscar or about, getting one over on old Hollywood, which is what they will be doing either way, by winning an Oscar or this deal.
This will be old Hollywood. This is basically old and new coming together. And so therefore, I think that distinction maybe disappears. I think what regulators do with this, I think, is going to be really interesting. Does this change the arithmetic when it comes to the consumer? Is this something that antitrust regulators will look at? It's interesting that the breakup fee is such a prominent part of this, and the antitrust story is going to be sort of front and centre.
What it means for other studios and their distribution, I'm sure, will be part of the conversation. Coming up on the programme then at 11 minutes past 7 here in London, we'll get back to that German story as the German government's infrastructure and defence spending boost lifts the country's medium-term growth outlook. We'll hear exclusively from the CEO of the German defence giant Rheinmetall. That's at 8:45 a.m. London time. Armin Papperger has been on the show a number of times before. Really interesting to get his take on where we are on the defence story and whether the German politics puts that in flux at all. Plus, in a Bloomberg scoop, Warner Brothers is said, as we've been discussing, to have entered exclusive talks with Netflix to sell its extensive film, TV studios and HBO assets to the streaming giant. We'll bring you more details of that with our deals reporter. Up next, we'll check in on markets as Bloomberg learns that the Bank of Japan is ready to raise interest rates at a policy meeting later this month. We'll be discussing that with Naomi Fink, Amova Asset Management Chief Global Strategist. Please get involved in these conversations. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Here we go. 44 minutes until the opening trade here in Europe. This is the futures picture here in Europe. Quite very similar to what we're seeing in S&P futures, which are up by, let's call it 0.2% right now. Equity markets, obviously, near fresh record highs. We're at record highs as we work our way towards the Fed meeting next week, which appears to have been pivotal. This move towards 25 basis points, absolutely central for US equities. National Economic Council Director Kevin Hassett giving his take on what the Fed should do with interest rates ahead of that meeting. He made these comments on Fox News.
If you look at the communications from the Fed governors and some of the regional presidents, they now seem much more like they're leaning in the direction of a rate cut, which is I believe, the right.
And how much would you like it to be?
You know, in the long run, we've got to get to a much lower rate. If there's consensus around 25 basis points, which it looks like there is, then I'll take it.
What's the long run and what's a much lower rate? Questions maybe for tomorrow. Let's find out what the 2-year looks like today. Valerie Teitel, over to you.
Well, there was some pressure on the front end yesterday, Guy. We did see 2-year yields creep higher over the session. We are higher still on the week, around 3 basis points. But yesterday's weakness was really around some speculation that Kevin Hassett's nomination could run into some road bumps on the Senate Banking Committee. There is a tight split on the Senate Banking Committee. Just one Republican holdout can really disrupt his nomination. The senator from North Carolina, Tom Tillis, is on that Senate Banking Committee. He was one of the Republican holdouts when it came to the one big beautiful bill. So perhaps his nomination might not be as clear cut as maybe the market would want. So we did see that weakness in the front end, and on Poly Market, his odds have now dropped from 85% to 75% to becoming Fed chair next year. However, this pressure on the front end didn't necessarily disrupt the equity market rally. We eked out some gains for the S&P 500 yesterday, a 3-day winning streak for the broad index, and we're less than half a basis point away now from all-time highs on the S&P index. Now, We know the month of December, portfolio managers out there really do want to protect their gains and limit their losses. So perhaps if the equity market starts to feel a bit more shaky, we could be due for some profit taking. It's all about what kind of signal could give the market to end up on that nervous line headed into year end. Perhaps it could come from a surprise decision from the central banks that we're still awaiting decisions from. As you guys mentioned, we still have 4 big ones left for the year. FOMC meets next week, and then the Bank of England and the Bank of Japan meet the following week, the week before Thanksgiving. The Bank of Japan is giving us some decent hints we could be in for a hawkish surprise.
That's what this is the story. Going into next week, thinking about the Fed. Is the Fed the surprise next week? What does Powell do? What kind of messaging does Powell deliver? Does it matter anymore going into next year? The BOJ really matters. Do we get 25 basis points as a hike, and do we therefore look for further hikes still to come? It kind of feels like that's where the narrative is. Let's try and develop that a little bit more. Valerie, thank you very much indeed. Joining us now from Tokyo is Naomi Fink, Chief Global Strategist at Amova Asset Management. Naomi, the Bank of Japan strikes me as being the most important event now between where we are now and year end. And next week kind of feels like it's going to be really kind of focused on where we go with this story. Yes, it's the Fed, but the BOJ, this huge pool of liquidity that exists out there in the world, and the Japanese provide a lot of it. And I'm wondering what your thoughts are on not only do we get a 25 basis point hike from the BOJ, do we get more next year? How high could rates go in Japan?
Well, it seems as though the Bank of Japan has signaled that they are prepared near term to hike rates, and I think the market's expecting it now. And so it wouldn't be out of line for Bank of Japan to step in with another rate hike. We know that Bank of Japan is on a normalization trend too, which means that they, in theory, shouldn't stop, even if they do have a lot of room between hikes until they get to somewhere around the neutral range. What is neutral? Well, I think that some of the Bank of Japan signaling says that in real terms, it's somewhere between -1% to 0.5%. So if we add 2% inflation to that, then we get 1 to 2.5. So the lower end of what the market seems to expect now as neutral is 1%. And even if we hike again, we still are short of that 1%. So I would at least expect the Bank of Japan to continue hiking until the lower end of that range.
What does that mean for Japanese pension funds? What does that mean for Japanese savers? What does that mean for the carry trade? Are we going to finally see the repatriation trade beginning to kick in? We saw this very strong auction this week of 30s. Are we starting to do we need to start thinking about that? And what are the implications of that if it were to happen?
Well, if we look at dollar-yen, the yen is very cheaply valued almost by any metric. Even the exporters are not expecting yen this week against the dollar at the end of fiscal year end. So it would make sense for both direct and portfolio investors to lock some of their gains in already. So some degree of repatriation wouldn't be so strange. But I would also add that there still is a decent amount of growth abroad. So I wouldn't expect people to be running for the exits on their overseas investments. I think some moderate degree of repatriation might be sensible to expect.
Yes. Should we think about that? Good morning to you, Naomi. Should we think about that repatriation flow as entirely dependent on interest rate differentials? Is it the pace at which the US cuts, the Japan hikes, and the extent to which we close the gap? Is that what will drive that repatriation trade?
Well, I don't think it should be entirely dependent. No, I think that there is definitely some influence from interest rates, relative short-term interest rates on dollar-yen. But the investments themselves really hinge on whether you think you're going to get a better return overseas than you are in Japan. And in some cases, the answer is going to be yes. In other cases, it's going to be no. I guess where dollar-yen is right now tells us that it's gone a little bit too far. So where we do see those carry trades, the more near-term dependence on where short-term interest rates are, if that adjusts, we should see some degree of return to the yen.
What does the politics look like and the relationship between the government and monetary policy, Naomi, in Japan right now? There had been talk a few months ago about this new Prime Minister pushing back pretty strongly against the idea of rate hikes. But our recent reporting suggests they might be OK with a hike in December. Where does that leave the relationship and the prospect of any pushback from the government later?
Well, I think politicians, not only in Japan, but in other countries too, they have to walk the thin line between stating their preference and undermining central bank autonomy. And I don't believe that central bank autonomy in Japan has been undermined yet. In fact, we've heard some rhetoric from the government that they do entrust the Bank of Japan to operate policies such as to keep inflation in check. So I think there is a good chance that Bank of Japan is allowed to do their job, keep inflation in check. And long term, that's actually going to help everybody because households right now are suffering from a high cost of living.
Naomi, let's introduce the Fed into this conversation. How big do you think the gap could get or widen between the BOJ, or I guess it's probably narrowing, the Fed is cutting and the BOJ is raising rates. How narrow do you think that gap could get in 2026?
Well, I think that also not only obviously depends on Bank of Japan and Japanese inflation, but it also depends on where we go with U.S. growth and inflation. And right now we are seeing signals that are somewhat conflicting. We're seeing some softening in the employment picture, for example, but we see inflation still riding higher than target, which is also 2% for the U.S. So if we do see inflation ease off a little bit and we continue to see deteriorating employment prospects in the U.S., then we should expect the Fed to continue cutting rates. Of course, if we do see a hang-up that growth isn't as soft and inflation refuses to come down, then we won't see as quick a normalization from the Fed.
Naomi, and with that in mind, with the sort of relative growth prospects of those two economies in mind, we think a lot about what AI might deliver for the growth story in the United States. Get us up to date on what AI will deliver in Japan, the extent to which this technology is embraced, of course, and the speed that you would expect that to have an impact.
Yes, so whether AI is going to have an impact and the speed, I think, are rightly two separate questions. There's a lot of investment going on right now into AI, and I can only guess that a lot of that investment is going to bear fruit. It's just that not all of it is necessarily going to be bearing fruit next quarter or next year. Sometimes it takes a few years for that productivity to come through. When it comes to Japan, there are clear incentives for adoption of AI. There is a declining population and a labor supply shortage. So even as you hike wages, you still don't have enough labor to really fulfill the demand that we're seeing. You know, we have capacity constraints. So there's every reason that there will be continued adoption of AI and other digitization in Japan. And I think that's going to continue for several years yet.
Naomi, thank you very much. Thanks for joining us. Naomi Fink, Chief Global Strategist at Amova Asset Management. Thank you very much for joining us, really taking us to the heart of the Japanese conversation, but importantly, setting that in the global context, what the closing of that rate gap between Japan and the United States will mean for global markets. With global markets in mind, on a programming note, let me tell you, we're going to be interviewing the Bank of America CEO a little bit later on in programming here on Bloomberg Television. Brian Moynihan will be joining the team on The Pulse. We'll be getting his thoughts, of course, on the US economy and consumer. You certainly don't want to miss that conversation, 9:15 UK time. Still ahead on the programme, Germany's Chancellor Friedrich Merz faces a key test in Parliament later today. It's all about a pension bill, which is interesting in itself. The voting around it is interesting, and what it tells us about his wider agenda and his power to deliver it also of interest. This is Bloomberg.
Half an hour to go to the opening trade in Europe. The focus is on the Fed. The focus is on the BOJ. We've got a lot going on. That is where the narrative definitely is centred. That's where equity markets have been kind of moving over the last few days. Yesterday, we saw a decent session in the States. It's going to feed through, it looks like, into Europe this morning. S&P futures are up by around 0.2%. Similar picture here in Europe. maybe up a little bit more. The bond markets?
Yeah, not a huge amount of excitement in the European bond markets. We have seen, though, the Japanese market, the JGB market, responding to our reporting, increasing chance of that rate hike coming through them from the BOJ. That's pushed up yields, certainly at the short end, over on the Japanese curve. It's not having a huge impact here in Europe. We see a pretty mixed picture, actually, between France and Germany. We're either side of the flat line when it comes to the European bond market story. Let's think about the political narrative around these bond markets, though, and go to Germany. The German Chancellor, Friedrich Merz's ruling coalition faces a key vote today. Parliament is to decide on a pension bill, one of the reforms pledged by Merz to reinvigorate Germany. Let's bring in Bloomberg's Europe executive editor, Chad Thomas, who I'm very pleased to say joins us from Germany today. Chad, really great to have you on the programme. So talk us through what's at stake for Merz today, because even if it seems from our reporting that even if he manages to get this pension bill over the line, if he has to rely on the opposition to a great degree, then that still leaves lingering questions about his ability to lead the coalition.
Hi, Anna. Good morning. This really is a key vote for the new chancellor. Remember, we only had an election in Germany in February. He's only been 7 months on the job. Chancellor Merz has a very narrow majority in the Bundestag. It's only 12 seats. And so there are a handful of people within his own party, the Conservatives, who are younger members who are saying that this is unfair, this pension reform, that it's going to push the burden onto the younger generations. And they have suggested that they're going to vote against it. Chancellor Merz has been having difficulties getting legislation through the German parliament since he took office, in part because of this slim majority. If he has to rely on potential votes from other parties in order for it to pass, that will be very damaging for him politically in Germany, with a lot of people asking what authority he has if he can't even get his own party together.
What would this mean? What does this mean? Say today it doesn't go his way. What does the story look like in 2026? How vulnerable could he be? Chad, the whole European premise at the moment, from an investing point of view, is basically based around the fact that Germany is going to be delivering a big fiscal push. Is that in any way being questioned now as a result of what is happening potentially today in the Bundestag?
Well, that is the question here, Guy. Can they deliver on all these things that they have promised? There has been huge optimism, as you say, around Germany that they're going to loosen the purse strings. They have been doing some of that spending, but Chancellor Merz and his coalition partners, the Social Democrats, have said that this would be a fall of reforms and changes, and it just hasn't materialized because they can't muster enough votes and ultimately agree with one another on what it is that they want to do to stimulate the economy here.
Chad, great stuff. We're going to look forward to this. We think the results likely around 1 p.m. Berlin time, so we'll all be tuning in to figure out what is happening at that point. Chad Thomas joining us on this key vote in Germany. A little bit of news coming out of the UK, which I think is probably worth focusing on. Valerie was flagging this to us a little bit earlier on. The UK is to hold no long-dated conventional bond auctions in the first quarter. There is this whole idea, and the Dutch are also part of this story, that we're bringing kind of the issuance story into the front end of the curve. It's setting a timetable of gilt syndications in January, March. That's the quarter that we're seeing. But plans to sell long gilts via syndication and mini-tender, but no long-dated conventional bond auctions in the first quarter. Let's talk about where we are with the bond markets globally and figure out exactly what is going to be moving us out of this year and into next year. We're joined now by Pooja Kumra, Senior European Rate Strategist at TD Securities. The temptation is already to start thinking about 2026, but I feel we're not quite done with 2025 yet. So let's talk a little bit about what we've still got to come. From a bond market perspective, what do you think has the biggest effect right now? What the Fed does next, or what the BOJ does next?
I think Fed, just because for BOJ everyone will be out for Christmas holidays, so
okay. That could provide a little light liquidity, though.
We'll still be here, Pooja.
Yeah. Okay.
But I think for Fed, we all are getting fixated about what they do next week rather than thinking about how the dot plot actually evolves for 2026, 2027. And I think that could be a bit hawkish for markets because if you remember September, they were just looking for one more cut in 2026. and the fact that we are reaching closer to the neutral, right? Most of the members are sitting around the 3 to 3.5.
Yep.
I think the key right now for me, worrying part of the markets for next year is that there's no steady path of reduction in policy rates.
Yep.
Because either central banks are at neutral or they're very close to, and they need to find the right balance between the hawks and the doves. So I think that is one thing that's the key challenge. I think the fiscal part of it is something that we've already played this year. So I don't think it should come as a new surprise for markets per se. And
the reason I bring up the BOJ is that last Monday, this week.
It was this week.
This week.
Seems like such a long time ago.
It does, yeah. Beginning of this week, the strength of the 30-year auction caused quite a gravitational effect, here in Europe, but also significantly over in the United States.
No, totally. I think right now, every day we wake up, our curves are moving to what happens in Japan. So definitely it's a key driver for markets. But I think one thing they're doing right this time as compared to what we were discussing 2 years back, they did not pre-announce their policy. Right now, markets are going much more prepared as to BOJ is ready to take action. I think the key for even Japan will be the global financial conditions and how the fiscal plays out, right? Like they're also trying to get more hand of how this new government is exposed to the fiscal side. But it does have repercussions. We know Japan is a big holder of global debt.
Yeah.
They have reduced their holdings across board, but I think it does ultimately come down to the level of yen.
Yes. Pooja, let me ask you, I mean, something that links Japan with Europe had been this expectation that perhaps we see reduced supply at the long end, that investors might be, or that governments might be trying to raise money more at the short end. And in fact, that applies to various geographies, doesn't it? And to Guy's point a moment ago, we've had this confirmation that from the UK, from the DMO, the Debt Management Office, that the UK is to hold no long-dated conventional bond auctions in the first quarter. What does that do to your thinking? Does that sort of drive up demand for long debt that is already out there? Does it, I mean, we understand the reasons why they might be doing this. I mean, how does it play into your thinking?
I think this has been an ongoing theme since the beginning of the year, and it has been supporting the flattening move of the curve. So for me, I still like holding a flattening bias because there's clearly not much buyer base. But I think ultimately how the entire yield curve is driven is more dependent on BOE policies. Will they be able to deliver something that is dovish enough for markets? Because what we are seeing right now is that on hawkish central banks, we are bear steepening, right? The longer end of the curve is reacting more. So supply is one supportive story, but for me, it's more about how central banks plays it, because if central banks shift to the dovish side, you create demand irrespective. So I think that is one thing.
And so what do we expect from the Bank of England? I mean, will there be anything to see here in terms of the language we get?
So it is a divided committee, and I don't think at this stage they would totally say that, you know, we are all clear after the budget and we are ready to cut rates. I think they will still have a very cautious tone, and if the tone remains similar to last meeting, I think it could be small bearish.
So do you think, I mean, mechanically bringing down inflation, which was one of the things we got from the budget, will that opens the way to at least one more rate cut?
Yes, that's what I was like. I mean, December cut is done, but I don't think that they want to totally rely on the government policies. They'll be more dependent on wage inflation in the Feb forecast.
Where do you think UK gilts, where do you think long-end gilts going? I saw a call yesterday for 6%. The fact that the market at some point is not going to believe that budget and is going to say it was backloaded and the funding's never going to happen and the spending's already occurred, and as a result of which there's going to be a funding crisis.
I think definitely there is a trust element to it, right? I mean, right now, deals have got a thumbs up from the markets. Gilt market approved of it. But they are heading towards May election. And I think the key thing right now is, do we see any U-turns in all the measures that they have taken right now? I think what we have done right now is, for gilt markets, the March budget seems they are a bit safe because Rachel Reeves has managed to create a big 22 billion buffer. But how does that buffer evolve into the May elections? I think that is the key driving part.
Okay, so you bring up the politics, so let's talk about the politics. Friedrich Merz is at risk. His government, this is Germany, this is the kind of the big spending story out of Europe. Keir Starmer's at risk. Emmanuel Macron at risk. Are we discounting, are we ignoring European politics too much next year? Could that, we've talked about the BOJ and the Fed, could European politics provide the turbulence in 2026?
No, certainly. I mean, UK is a bit scary one because we are more reactive to anything that happens.
Yep.
I think for France, since 2024, we have been reliving the 2027 elections, right? So I think the story will repeat itself again. I think Germany is key for us because, the entire year we have been in this hopes that we will have this big whatever it takes moment. And if you see a very fragile government, I am worried that this entire investment spending turns into a consumption spending, and which comes in form of term premium on bonds, right? So I think that is something that I would be more worried about.
Does it show up in bond markets then? Because, I've seen quite a bit of people talking about the risks around the euro perhaps here, but even that's a bit tangential. Does it really go so far as to impact on bond markets?
I think that term premium element will be there because ultimately markets will be like, we are seeing supply on a daily basis, but where is the growth coming from, right? I think that is something that I would be worried about. I'm less worried about it being as dramatic as what we see in UK moves or French moves. I think markets actually trust the bond market, but it just tells you that the term premium element will continue to increase.
Some of the language from the Germans around the growth story really quite alarmist. The BDI, that group represents business, talking just earlier this week about the economy being in free fall and talking about the German government not doing enough, even though they're doing so much, but it's not quite yet.
We don't want more.
But it hasn't come yet. This is the problem. And if you look at the data short term, the data in the near term looks really quite poor out of Germany. And you need to correct that pretty sharpish, I think. And you do look at the ECB and think, kind of, at some point, if this, how much are they hanging their hat on the idea that Germany is going to deliver next year?
I think to add to that point, they have just added 0.2, 0.3 percentage for their growth in the next 3 years. So they're not depending that much on this fiscal to add to growth. So they are not particularly optimistic.
Pooja, thank you very much. Pooja Kumar, Senior European Rate Strategist at TD Securities. You nearly jumped out of your skin when we mentioned maybe Germany doing more, but that's not the bond market doesn't necessarily want to see that. Right, we'll return to that conversation, no doubt, as we go through the weeks towards the end of the year and into next. Now, let's pivot to Warren Buffett, in fact. The legendary investor and Berkshire Hathaway CEO Warren Buffett is retiring at the end of this year. For many investors, it's the end of an era. Bloomberg Originals looks at how Buffett changed investing forever and what's next for the company he built. Here is a preview.
If investors had a Hall of Fame, Warren Buffett would occupy his own wing.
People from all over the planet look up to him, read his biography, hop on a plane to go see him talk.
He took a failing textile mill and turned it into a $1 trillion conglomerate. It has insurance companies, Dairy Queen, railroads, and energy businesses.
For decades, Buffett's investment savvy has led Berkshire Hathaway to beat benchmarks.
One of the biggest asset managers today, which is Vanguard, the entire philosophy is no one's really going to be able to beat the market, so you might as well not even try. Well, okay, no one besides Warren Buffett.
If you look at the total returns, Berkshire blows the S&P 500 away.
The legendary investor Warren Buffett.
So when the 95-year-old announced he would retire at the end of 2025,
Greg should become the chief executive officer of the company.
It marked the end of an era at Berkshire Hathaway.
Greg Abel led Berkshire's energy business for so many years. But it is tricky. Warren Buffett has not only been a very good investor, but he's also pretty charismatic.
He won't be writing the annual letter next February. This is a big change because Buffett fans have been poring over that letter over the years because it's full of witticisms, investment advice, pearls of wisdom. There's also the fact that he's not going to be taking Q&A at the annual meeting next May in Omaha.
Morning. Welcome to Berkshire Hathaway.
He was talking for 4 to 5 hours every year and taking questions from people that follow him all over the planet. That is going to be a big change because Buffett's personality is unmatched in the investment world.
Wonderful image at the end of that. Now, subscribers can watch the full documentary on the terminal and Bloomberg.com. It will also be available on Bloomberg's YouTube channels at a later date. Still ahead on the programme, the Stellantis CEO is touting promising signs of a turnaround. More on where the automaker is seeing growth in today's stocks to watch next. This is Bloomberg. Welcome back, 7:48 here in London, and this is the picture across European equity markets. It looks green. Things are green on the board for European stocks. The Asian session has been slightly green, and US futures also pointing a little higher. Nasdaq futures up by 0.4% as we head towards the end of the week. Let's broaden the conversation then and talk to Skylar Montgomery-Koning from our Markets Live team, who is with us this morning. Skylar, good to have your perspective on the programme. It feels like we started the week with the BOJ. To some degree, we're ending the week with the BOJ as well, with a Bloomberg scoop that sources are telling Bloomberg that the BOJ is ready to hike on the 18th, 19th of December, as long as nothing enormous happens between them, which still leaves kind of half a month. So we will see. But what is your evolving thinking around the BOJ?
Yeah, sure. I mean, I think it's quite funny with the Bank of Japan. We tend to get the policy surprise before the actual interest rate announcement. So they like to well telegraph what they're planning to do. So I think it is very likely that we do get this hike. There were some questions around when it would come because of the fiscal going on there. But I think we knew the direction of policy very clearly. That means it's likely upside for JGB yields. It adds to kind of a number of reasons why JGBs are relatively unattractive within the kind of DM government bond complex. And it's not just because they're hiking as the rest of developed markets ease, but you also look at something like there's this big duration mismatch within the country. So as you raise policy rates, there's a worry that fiscal capacity gets deteriorated more quickly than elsewhere. You also have that a lower ceiling on where the policy rate can go because of that duration mismatch, and it's lower than other places. And so you still have a relatively unattractive yield. And then on top of that, you've got fiscal, which means growth will likely be higher. That's negative for bonds. At the same time, you have more issuance, and the Bank of Japan is reducing holdings. So it just means that you're still kind of relatively unattractive, and it adds to that bias.
Okay, can I just dovetail the BOJ and the Fed? I'm trying to wonder which one provides the bigger surprise. It feels like the BOJ is kind of taking the Fed's playbook of dropping lots of hints beforehand. And we've had one through Bloomberg today. I'm wondering if we get another one next week, just to kind of cement in, as you say, the idea that we are going to see this cut coming. Do they start signalling the idea as well that there could be more to come? And that's kind of wondering if the big surprise, that's kind of the ultimate big surprise here. Is that with the big surprise, or is the Fed going to provide the big surprise? What's price for the Fed at the moment? Kind of the Fed versus BOJ. Which one should we watch more?
I think definitely the Fed, not only because it has more spillovers to global markets, but I think we've moved pricing very dovish in the last couple of weeks. So if you look at something like 25 basis points being pretty much guaranteed in terms of pricing next week, Kevin Hassett bets rising that he will be the Fed chair, as well as your terminal rate at 3%. It's harder to get lower than that without significant economic deterioration, which means those are three factors that could surprise on the hawkish side as you go into this meeting. So I think that's where you should be watching, especially because you get a new SEP, so you get new dots, you get new projections. And I think what will be key, especially because you have a new Fed chair next year, and we're moving away from this idea that the Fed chair represents the consensus, is a more divided Federal Reserve.
Yeah. And on the subject of the US, PCE later, very delayed. Does the market try to look through this number?
I think it's going to largely be ignored because we've already shifted pricing dovish. This is an old print now. You're also having expectations that core PCE will come in close to 3%. That's a very high bar to surprise hawkishly. And as I said, there's not as much room to surprise on the dovish side. So likely look through it. And the big surprise we're looking for in terms of that hawkish shift will have to be the Fed next week and commentary there.
Okay, Skylar, thank you very much.
Okay, let's talk about, you can get more coverage from the MLive team. And next week's going to be huge. MLive Go on your Bloomberg terminal. Stocks to watch. We're starting in Germany. Chloe Melly, over to you.
Good morning, guys. So, let's keep an eye on German stocks today, given some of the political uncertainty that we have got going on in the country at the moment. There's a really key vote in the German parliament on a pension bill today, and the stakes are really high for the chancellor because some of the lawmakers in his own party have pushed back against that bill, and that could precipitate the demise of a coalition that's already quite fragile and potentially lead to new elections in the country. So let's keep an eye on some of those key German industries, of course, names across the defense, industrial, tech sector, and see how they react to that political instability this morning. Moving on to Stellantis, and there's a couple of things to keep in mind for Stellantis. Today, on the positive side, we've got an upgrade from DZ Bank and also the CEO saying there were really promising signs of a turnaround at the Jeep and Ram brands. But on the other hand, the fact the company has refocused so much on the US is causing some trouble elsewhere. And the Canadian industry minister has said that she had served a default notice to Stellantis and that this was really to protect that car making sector in Canada, because Stellantis had moved some of the production of Jeeps to the US. So let's see how the market digests both those positive and negative developments for Stellantis. And finally, let's finish on the pharmaceutical sector. And UCB has upgraded its 2025 guidance. This is a biopharmaceutical company, and a lot of that is going to be driven by its skin disease drug Bimzelx, which has been having a really positive, really great performance this year. That's really driven the rally, quite an impressive rally that we have seen over the last year. And so we'll see if we continue on this really positive trajectory for UCB today on the back of that upgrade.
Chloe, thank you very much. Chloe Melly with an update on some of the individual stocks. Swiss Re also in focus. I'm reading that could be moved. On the move, they've announced a buyback, so that could be something we watch. The broader picture, though, does feel a little bit more December-ish, doesn't it? Little quieter, and very December appropriate that we are alert for news from the BOJ, because it seems to be their MO.
Yeah. Are they going to give us enough warnings, though? Is that what we're in the process of doing? The Fed has this history of kind of giving the market very strong hints through the Wall Street Journal. Are we seeing a similar thing being demonstrated by the BOJ? And does that continue in terms of the signalling that we get towards that meeting?
Yeah.
They want to do it before the meeting, it seems. So is it kind of next week, the week after, that those kind of hints continue and the drumbeat towards that meeting continues? Keep an eye on cybersecurity stocks as well out of Europe today. Keep an eye on auto stocks out of Europe today. There's plenty happening as we head into the market open. This is what futures look like. Quiet-ish. Single stocks could be more exciting. That's what we're looking at into the open. This is Bloomberg. We're nearly there. Fresh all-time highs kind of within view of US equity markets. But yesterday kind of bumped around a little bit trying to get in that direction. We kind of basically just kind of went sideways. This is where Europe went out. We kind of went out here. We rallied a little bit. There's a little bit of headroom therefore on top for the futures picture in Europe this morning. US futures are kind of up a little bit as well, but not by much. So let's take a look at European futures. It feels again like it's going to be a kind of bottom-up market rather than a top-down market. What are single stocks doing? Which key sectors are we going to be watching out for? Futures at the moment kind of pointing us up by around, 0.2%? That's kind of the broader picture. Eurostoxx 50 futures up by 0.2%, FTSE futures 1/10, DAX futures 2/10, CAC's up a little bit more, but not by much. So it's a kind of, it feels like we're in wait-and-see mode. Where does the catalyst come from? Is it bottom-up single stock stories that are going to be doing it? Is it central bank stories? What can we get from the Fed? What hints next week do we get from the BOJ? Does it continue this drumbeat towards the idea that we are going to be seeing maybe this hike coming through? But what is the message beyond that from the BOJ? ECB and the Bank of England we've also got on deck. Plus there's politics. Look at what is happening in Germany. That's a story that we're going to be paying attention to as well. So there's a lot going on, but I do wonder whether today's session, what kind of single stocks are we going to be watching out for?
Yes, well, one sector certainly in focus that you flagged to me earlier, Guy, was the cybersecurity space. So watching European cybersecurity stocks because of Sentinel-1, their forecast for fourth quarter numbers fell short of estimates. So we'll watch to see if there's any read across there. UCB, this is a biotech business, and they seem to be guiding a little bit higher this morning, so we'll see if we get a pop in the share price there. We're also focused on energy stocks. This is to do with some ratings. So B of A Global Research cutting their recommendation on BP to underperform. So we'll watch to see if that has an impact. Guy.
OK, here we go. Time for the Friday session. The week is almost closed. It's been a long week. There's been some really interesting things happening this week. Where do we find ourselves at the end of the week? Near all-time highs, certainly over in the United States. Europe kind of drifting sideways as the market opens this morning. FTSE 100 up by 0.1%. I'm interested to see how the CAC opens this morning. Maybe there's a little bit more momentum potentially in that market this morning. What's happening with luxury stocks? But Germany, front and centre as well. What's going to be happening in Germany today? The politics is going to be having an influence. This 1 p.m. Announcement potentially on this key vote that's happening in the Bundestag today could be crucial for the afternoon session here in Europe. The IBEX is up by 0.2%. The big outperformer so far this year. The CAC's actually not delivering that much much on the upside. I was expecting maybe a little bit more, but we're up by 0.3% on the CAC Current. Do we get a little bit more as we kind of start to fully open here in Europe? The DAX and the SMI will wait. We'll see what happens there in just a moment. Anna, sectors, single stocks, what are we looking at?
Yeah, sectors. So I'll start at the bottom of the pack, shall I? And rightly, our team flagging the energy sector to keep an eye on because of that B of A note. And I mentioned BP. It's actually wider than that. They've actually been pretty scathing of BP and Shell. So they downgrade to some degree, both of them. They cut their recommendations on BP and Shell as lower oil and gas prices are deflating refining margins. This is the view of analysts over at B of A, and that has had an impact on the start of trade this morning. So we see the energy sector as the worst performing. BP is one of the fallers within that, so it's down by 2.7%. So we're watching to see what happens with the wider energy space there. So that's the bottom of the barrel. Barrel inadvertent there. Insurance is also not looking great this morning. That sector down. Swiss Re actually down by just over 5%. So there's clearly something in the announcement that they put out this morning. But that's where we are at the bottom. They announced a buyback, which I had mentioned ahead of the open, but that doesn't seem to be pushing the shares higher this morning.
Rolls-Royce, AstraZeneca, EssilorLuxottica, Siemens Energy, Airbus. In terms of the kind of the points, that's where the gains are coming from in Europe. So a little bit of an engineering bias maybe coming through, industrials bias. I think there's a note out on industrials today, actually. Somewhere, I'll find that in just a moment. But elsewhere, a kind of reasonably eclectic mix of stocks. Airbus coming back a little bit. Some of the pharma stocks, which got beaten up a little bit yesterday, maybe coming back a little bit as well.
It seems, and you were flagging the copper price earlier on. That does seem to be pushing the basic resource stocks a little bit higher this morning, even as iron ore prices are a little weaker. But it seems like the copper story perhaps winning out, and the basic resources sector is one of the better performing ones this morning. Let's go to what's going on in bond markets, because yesterday we saw the markets moving, the gilt market specifically, moving ahead of an expectation that we'd see the DMO pulling back on issuance at the long end of the curve. We got confirmation of that story this morning, and so actually in the event it seems that the markets don't have too far to move on the news. They moved on the rumour and they moved on the expectation yesterday, and we did see the long end of the curve moving quite substantially yesterday, but that's not the case today. We're seeing a slight move higher in yields, but it's sort of across the curve. Maybe it's already reflected in what we were expecting.
Absolutely. And it's going to be a similar story maybe elsewhere in Europe as well. There's a nice story on the Bloomberg Terminal this morning talking about how the Dutch pension reform may force actually governments to migrate towards that front end, which in some ways is an opportunity but also poses a risk, obviously, kind of as you bring the duration in. Just means you're kind of more susceptible to the change in the wind.
Let's talk about what's going on in global stock markets then as we head towards the end of 2025 into 2026. Beata Manthey joins us, Head of European Equity Strategy at Citi. Beata, very nice to speak to you. Thank you for being with us. I'm just looking at some of your latest research, and you say that you remain constructive on European equities. So towards the end of the year, into 2026, what is the key driver that means you stay constructive on Europe?
Good morning. Yes, this comes from our 2026 outlook that has just been published this morning. And the constructive view is based on really many things coming together into the next year, positive triggers, right? So number one, we are having a more resilient global economic growth. It's been very resilient this year, despite the headwinds. We think it's going to remain this way into the next year. There is some softness out of the US labor market. That means the Fed will underpin this constructive outlook with the cuts. We think they are going to cut 3 times. And then domestically in Europe, we are going to have expansionary fiscal policy, finally, next year. This year it hasn't been expansionary yet, it's been restrictive. So we are going to see some of this expansion feeding through into the data. And let's not forget that the ECB easing cycle, that of course has come to an end a few months ago, the effects of that easing will only come through into the economy next year. And we are already seeing it in the outlook for EPS and outlook for broader set of sectors.
So on that fiscal push, we're closely following a vote that's taking place in the Bundestag today, and the German coalition trying to push through some pension reform. And a lot of people are looking at this to give a sense of the authority that the Chancellor has within his own coalition, his ability to deliver his programme, which of course includes a huge amount of fiscal spend. Is that just intact anyway, regardless of what happens with this sort of mini-drama around pensions today?
So what I would say is Germany has gone through seismic changes. This type of changes don't come through very smoothly, right? We knew there was going to be some teething phase along the way. But what I would focus on is the fact that the budget has been approved, the money is being issued and deployed. So things are going in the right direction. And look at the economic data, actually. The momentum of economic data in Europe continues to improve as per our Citi economic surprise indices and underlying data. The data out of Germany today, earlier in the morning, in terms of factory orders,
very strong.
Up, very strong, up, revised up the previous month, and the domestic orders up almost 10% month on month, right? So you can see this fiscal and cyclical revival uptick starting to come through in the data. So that's exactly what we need.
We often talk about the fact that the US stock market is very concentrated, and the Mag 7 has delivered, in terms of the performance, a huge amount. In Europe, it's the banks. The banks in Europe are up 57% this year. The next best performing sector is the utilities, up 25%. Banks, it's all about the banks. You look at the IBEX, massive outperformance this year because of the banks. Are the banks going to deliver again next year? Because that appears to be crucial.
Absolutely. So perhaps you won't have a repetition of such a concentration of and dispersion in terms of sectors' performance that one sector is up 50% and everything else at least half behind. But given this macroeconomic backdrop I've described, this is a very good backdrop for banks to continue to do well, right? And then add to that actually perhaps some sentiment from the corporates picking up, sentiment from the consumer picking up. It's a very good backdrop. So we've been overweight banks, we continue to be overweight banks into the next year. But we also couple it with the sectors that will be beneficiaries of this industrials revival, of the fiscal, and of secular themes that are going in the economy. So today we've upgraded industrials to overweight, we've upgraded basic resources to overweight.
So it broadens out.
So it broadens out, yes.
Should US investors invest in Europe next year? Because the dollar looks like it's going to be a significant factor, a big kind of swing in that story. The IBEX has done very well this year, Spanish market, driven by the banks, up 44%. If I'm a dollar investor, I've done 62% in the IBEX this year.
Absolutely.
Does that tailwind for European equities continue?
The tailwind continues, but could take a different form, right? Because let's concentrate on this dollar. This is a very good point. Let's not forget that actually I rounded out IBEX to the entire European market that has done remarkably well, especially in the US dollars, despite a big chunk of the market doing quite badly. So it's been a market concentrated and driven by the domestic story, therefore banks doing so exceptionally well, right? Into the next year, we see it in the EPS, and the dollar, some dollar weakness into this year will help as well for the upswing in the internationally exposed sectors. So 15% appreciation of euro-dollar has been a huge headwind for EPS of that part of the market, actually dragging the entire EPS for Europe to only 2% from 8% expected at the start of the year. Next year, dollar could be a swing in the EPS broadening, so more sectors doing well from the EPS perspective and therefore performance perspective. And in terms of US investors, I think there continues to be the need for diversification, given the volatility related to the rhetoric around AI theme. Right?
Yes. Let me ask you about how that plays out for Europe next year. Where do we look in Europe, Beata? Clearly we talk about the companies that make the cables, the companies that do the electrification. There are names we can point to, but and energy businesses. Investing in grids and that sort of thing. Is that where the focus remains, on the AI story next year?
I think Europe is at a very interesting crossroads where the broadening of AI, and we think the broadening is not only going to be about the providers of AI, but of users of AI, right? So Europe, with its domestic spend concentrated on infrastructure spend, part of it is build out of data centers, electrification. Our analysts also point out to the physical AI, so robotics in the manufacturing space, right? This is where fiscal spend in Europe, which is quite unique, is going to meet the next stage of AI broadening. So yes, a reason why we've upgraded industrials, because we've been overweight and bullish certain parts of it this year, but we are broadening it out as well.
Two kind of related questions in one, I promise. FTSE 100, is it still cheap? And is it going to be the commodity play next year as I see things like copper moving sharply higher?
So it's cheap versus other regions, but it has re-rated a lot, right?
Yep.
It's not cheap versus its own history. Nothing is in the global equities anymore, and FTSE 100.
Nothing is cheap anymore.
No, well, you can find some selective sectors, right?
Right.
So value is still cheap versus its own history.
That doesn't include banks anymore, does it?
Well, I would say banks are still cheap,
Wow,
despite an outperformance, because they are still trading at single-digit Ps, and they are versus their own history that we look a lot at.
But nothing is cheap. Not even the FTSE.
They are trading in the middle of the 25-year valuation. FTSE is in the 60th percentile right now. So
cheapish.
It's cheapish, yes, absolutely. So basic resources, definitely, as I've just mentioned, we have upgraded it to overweight. However, FTSE 100 is a very specific sector when it comes to the sector weightings, and it has a lot of weight in defensive sectors. Given the backdrop, you want to be more in cyclicals. So it doesn't mean that we are particularly bearish on FTSE 100. Yeah. We have a decent upside over the next 12 months, 10%. However, on a relative basis, if the market wants cyclicality, continental Europe is better positioned to do that.
Yeah, defensive, but defence and banks have driven the FTSE 100.
Exactly.
This year. Anyway, Beata, nice to see you. Thank you very much indeed for coming to see us. Beata Manthey, bringing us her outlook, if I can speak this morning, on next year, joining us from Citi. Core 6, let's talk about exactly what we are watching this morning in terms of some of the individual moves that we are seeing. It looks a little bit like this. We're going to be talking to Rheinmetall very shortly. That stock is down by 1.2% this year. Elsewhere, we are seeing farmers coming back, Nestle a little softer. But let's start with the energy space. A big note out this morning, having a big impact in terms of the European space. Let's find out the details of that with Chloe Melle.
Good morning, Guy. Yeah, we are seeing some weakness across the oil sector this morning. So we had JP Morgan double downgrading Eni, and then Bank of America also downgrading BP. So both sets of analysts have said that this is a sector that will have to deal with the risk of oil oversupply coming next year, and that this is a sector that will also be facing those lower oil prices, lower gas prices, and deflating refining margins. And that will put pressure on the cash flow for those companies. And therefore, we are seeing this really drag down those shares, especially for BP, which is down 2.5%, excuse me, this morning. Moving on to the defense sector, and we have got two different stories there, with Rank Group up and Hensoldt down, and that's because of a note from a Bank of America, which double upgraded Rank Group whilst downgrading Hensoldt, to saying that there was a really attractive pipeline of opportunity for Rank Group, but that the momentum was probably going to be slowing down for Hensoldt. So it's quite an interesting note that talks about two companies that are within the same country and within the same sector, but with two different stories going forward. Moving on to Greggs, which is up this morning after being rated a new overweight rating by JP Morgan, saying that it's will be a structural winner within that food retail sector. It's up quite strongly on the back of that upgrade. We're up 6.5%. This comes just a few days after news that an activist investor has been pushing Greggs to cut those costs so that it doesn't become a takeover target. But it's a good day for Greggs today. And finally, also a good day for UCB, which has upgraded its guidance for 2025. That is thanks to a really strong performance of its skin disease drug, Bimzelx, and that's really driven that rally over the last year. And we are up also this morning on the back of that guidance upgrade, and we are up almost 6% for UCB.
Chloe, thank you. Chloe Melle from our equities team, of course. Now, coming up on the programme, a Bloomberg scoop, Warner Brothers Discovery in exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. More on that just ahead. This is Bloomberg. Welcome back. This is the opening trade, 18 minutes into Friday's session, which is delivering some green on the screen for European stocks, making some modest gains. US futures also pointing higher. E-minis up by around 0.25% to end the week. Now, Bloomberg has learned that Warner Brothers Discovery has entered exclusive negotiations to sell its film and TV studios and HBO Max streaming service to Netflix. For more on this Bloomberg scoop, let's bring in our deals reporter, Manuel Bagori, who's got all the details on this. Manuel, this is a story that's been unfolding for a while. Multiple conversations have been happening, it seems, at the same time. So how significant would this be if we see Netflix taking possession of this, one of Hollywood's crown jewels?
It is, Anna, a very significant move. Definitely also a surprising one by Netflix, which, as we all know, has been trying to find new sources of revenue and growth after being very successful in the paid streaming, becoming the world's largest. But now, obviously, the company needs to diversify and keep growing, and it is zeroing in on Warner Bros., the TV and film studios, plus HBO, as you well explained. A very remarkable move. It's been ongoing for a while. There's been a sale process there where different parties looking at it, but it seems as if Netflix is pulling ahead, and they just enter exclusive talks, which would lead to a potential deal fairly soon. That's what we hear from sources. So definitely a transformative deal in the entertainment industry ahead of us.
That's all, folks. How big a risk is there that this doesn't get done, that regulators stop it? I'm fascinated that all of the stories flag the breakup kind of fee that is being attached to this. And I'm assuming that's there for a reason. Are regulators going to be comfortable with this deal?
Yeah, that's a really good point, and also remarkable, the $5 billion breakup fee that we are seeing. We understand that they are actually offering just in case the deal falls apart. The regulatory landscape is always a bit of an uncertain one, and it can go either way. I'm sure advisors are spending lots of time going through all the potential scenarios. But it remains to be seen how possible it will be to actually go from signing potentially the deal in the coming days to actually completing the deal. It might be a bumpy road on that front, and that's why also the fact that Netflix has offered that massive breakup fee suggests that could be a breaking point also for them to gain exclusivity.
Manuel, great stuff. Looking forward to the reporting on this. Manuel Bagori joining us on the media landscape and how that's changing. I want to talk a little bit about how the auto sector is changing, because there's some quite significant shifts underway at the moment. Let's focus on Stellantis. Stellantis says buyers apparently are snapping up vehicles in its refreshed Ram and Jeep brands. The reason for this is that they've basically added a whole load of V6s, powerful engines, more options on the hybrid front are also coming through as well. The group apparently received 50,000 orders for a Ram pickup with the Hemi V8 engine in it within 6 weeks of bringing back that kind of powerful powertrain to the market. Let's talk about all of this with our transport reporter, Danny Lee. Danny, the V8 is back, the muscle car is back. Just talk about how this is going to change the outlook for Stellantis.
Yeah, this is a very important time for the relatively new CEO, Antonio Filosa, just to get this restructuring, this massive restructuring, to try and revive flagging sales for Stellantis. And ultimately, it's the recipe that you stay true to in business. Give the customer what they want, whether it be bringing back engines on some of those 4x4 pickup trucks or SUVs, and even to bringing in a whole range of hybrid options, hybrids in markets such as the US has been very contentious. There is changes in legislation and rules which could affect the outlook and the consumer habits. But when it comes to some of its most important flagging brands, the likes of the Ram and the Jeep, these are critical changes that Antonio is making in order to try and revive the brands. And by making these changes, he is feeling more upbeat about demand, and maybe he's thinking about how this feeds into the rest of the portfolio of brands across Europe that he oversees and presides over. So clearly there is a lot of thinking going on and executing. And as you said, the 50,000 orders, bringing back a model with an engine, that's a pretty sizable success that he's now can assess and see whether that can translate into maybe other changes to other brands.
Yeah, we saw actually the auto sector was the best performing yesterday in Europe, Danny, as a result of a real shift in expectations for what this sector can deliver from here. Much troubled, of course. So what is the outlook for the wider auto sector as we look ahead into 2026?
Well, the wider auto sector is still kind of dominated by this level of Chinese competition. We already see the Chinese automakers really upping their targets to sell internationally. They've had a lot of success in Europe when you see the likes of BYD, who's outsold Tesla. But still, those legacy automakers in Europe, they are struggling in markets like China. That kind of legacy, the luxury story is also a bit of a struggle for some of the likes of BMW and Porsche and whatnot. So there is a challenge there, and so I think we're probably going to model through a little bit of 2026, and as we wait to see a lot of these restructuring and these transformational changes and strategic changes pull through.
But it feels like the Trump administration is backing away from some of the Biden-era emission standards that were put in. You're now starting to see real pressure coming out of Germany for Europe to do the same. Is that going to be the story in 2026, that actually it becomes easier to build old combustion engines than maybe push forward with new EVs?
I think that's a real question, right? Whether, what you see in the likes of the US and whether some parts of Europe, whether that they've calculated that cost, that keeping those combustion engines alive for a lot longer. And of course, I think at the heart of this will be jobs. It's a critical time for Europe, thinking about how to ensure that you keep these economies ticking over. It's those white collar or those blue collar manufacturing jobs at stake. So I think there's going to be a lot of hard thinking and pressure on the executives in the auto sector boardrooms just to see what the US does and how they might be able to follow and perhaps also appease Trump on things such as kind of cleaner, greener engines as such.
Danny, thank you very much. Bloomberg's Danny Lee joining us there with the latest on the auto sector. The auto sector, of course, close to the European economy, Germany, France. France, we're seeing the French President Emmanuel Macron has been making a visit to China. There doesn't seem to be a huge amount to show for the visit in terms of deals announced, but
no Airbus aircraft orders.
There we go. We're always looking for that.
Big aircraft orders.
We're always looking for those. But there are pandas. There are always pandas.
Pandas are really so the French are going to get some new pandas.
That's the biggest smile you've done all morning. I mentioned the word pandas.
He doesn't love a panda. So yeah, it's going to be really interesting. Do we get pandas here in the UK if we get a new embassy, a Chinese embassy? What's on the line here?
Hopefully not in the embassy.
Hopefully not. Well, maybe.
Yeah, I mean,
maybe London Zoo.
Bear in mind that they never belong to the people they're.
No, they're on loan.
They're always on loan. Goes back to the 1950s, apparently. Use of pandas as diplomatic ambassadors by China, in this case to France. Coming up on the programme, we're going to talk about the European banking sector. Jose Manuel Campo joins us, chair of the European Banking Authority, the EBA. A new report out today around the risks that they are monitoring for European banks. That's next. This is Bloomberg. This is the opening trade. This is Friday, 30 minutes into Friday's session. Happy Friday, everybody. European equity markets are positive this morning, up by 0.3% for markets overall. Pretty similar gains across these European equity markets. US futures have also been pointing a little bit higher. Looks as if we're, at least from this early morning perspective, starting or finishing the end of the week on a high. A lot of volatility driven by central bank policy towards the beginning of the week. Expectations around the BOJ. Does that continue to be a theme as we go through December? The Fed meeting, of course, looms on the agenda for next week, Guy. We've got the Bank of England, the ECB. Plenty of central banking conversations still to be had. So we'll certainly keep those in focus as we look at these modest gains for European equity markets.
Slightly obsessed with the BOJ, and I'm wondering if kind of more hints come next week. They like to pre-warn. They like to keep us on our toes as we go into key meetings. Is that going to maybe eclipse maybe the story around the Fed next week? Plenty of people are telling me no, focus on the Fed, but keep an eye on the BOJ. Huge source of funding for the global economy. Let's talk about what we're seeing in the market this morning. Higher, lower, definitely got a bias to the upside this morning. 412 up, 178 down. Volume is fairly flattish. These are the leaders. We'll whip through these fairly quickly. Novo, UCB and Banco Santander. Banks have been the key driver. Spanish banks in particular have been the key driver this year. Actually, I think the laggards are more interesting this morning. This Bank of America note on what's happening in the energy space actually having a fairly big impact. Shell and BP are both down on the back of that. BP really quite sort of hit hard by this note this morning. But Swiss Re is also down quite hard as well, down by nearly 6%, 5.7%. It does look as if the return of money to shareholders looks a little underwhelming. The outlook looks a little underwhelming. That seems to be the nod that we're getting through in terms of the reaction to Swiss Re this morning. So its stock is down by, as I say, 5.8%, Anna.
Let's get an update then on some of these central bank stories that we've been covering this morning. Bloomberg has learned that the Bank of Japan officials are ready to raise interest rates at a policy meeting later this month, provided there's no major shock to the economy or financial markets in the meantime. The central bank is also expected to indicate it will continue to raise rates if its economic outlook is realised, while remaining cautious on how far they will eventually push rates up. The German Chancellor, Friedrich Merz's ruling coalition, faces a key vote in Parliament later today. Parliament is to decide on a pension bill, part of the reforms pledged by Merz to reinvigorate the German economy. If the vote doesn't go through, it could precipitate the demise of his leadership only 7 months into its 4-year term. And European nations are looking to lower the length of their borrowing as an overhaul of the Dutch pension system reduces demand for longer maturity bonds. In an early sign of what could lie ahead, Austria's debt chief says this week that it has room to go lower in the average maturity of its debt after years of targeting longer tenors. We had an update from the DMO in the UK with this theme in mind as well, Guy.
Let's bring you a bit of breaking news that we've had over the last couple of minutes. It relates back to actually Friedrich Merz. We'll come to that kind of link in just a moment. But the headline looks a little like this. The US apparently is urging Europeans to oppose a plan. This is an EU plan that we see a loan being used to support Ukraine. And this is the basis of this loan is around the frozen assets, the frozen Russian assets. Now, Merz is meeting the Belgians today, which at the moment the Belgians are effectively blocking this this loan being pushed forward. And it's going to be interesting to see ultimately what comes out of this. But the US, which is in some ways, this is one of the few levers that Europe has to pull at the moment, this loan, this critical loan for the Ukrainians. And the US are basically saying, no, don't do that. Yeah. In some ways, you could argue this is the US maybe trying to remain in control of the narrative or dominate the narrative. But it's interesting they're pushing back on this particular idea.
Yeah, absolutely. This new line that US has been weighing on some of the European governments to try and oppose this plan is interesting. And we've seen Belgium, of course, being at the forefront of that. Belgium, for their part, they've had concerns domestically that they're the ones that would bear the risk if there were in future legal action taken against Belgium or the EU for having done this. Now, lots of European voices we've heard from them saying, look, we're going to put in place legal systems that mean that Belgium wouldn't have to shoulder all of the legal vulnerability here and all the risk. But that's not been enough for Belgium. And so it will be interesting to see whether Friedrich Merz is taking that message to Belgium when he goes to meet today, or is he mindful of that US pressure?
And it's interesting, the ECB has also kind of backed away from this too. But the European line seems to be basically that the money is here, and therefore it is our responsibility to figure out what to do with it.
Yes.
And Merz's line is, we're not going to leave this to the US. We control this asset.
Yes.
And the US, Washington, does not.
And the ECB hasn't necessarily spoken out against Europe doing this. They just said for their part they won't break the treaty to enable it to happen. But they've seen ways of doing this without the ECB's involvement.
OK. We'll continue to monitor this. This is obviously one of the key European stories they're going to be watching today. Let's talk a little bit about what we've seen so far this year. We were talking about this a little bit earlier on the programme. European equity market performance this year has been largely driven by banks. The banking story has been absolutely front and centre. It is by far and away the sector that has driven European performance. Look at markets like Spain, where there has been significant outperformance, and that has been largely driven by the Spanish banks. However, the European Banking Authority, despite all of this, which is a huge positive, is calling for continued vigilance in its latest risk assessment report, citing persistent geopolitical uncertainty, market volatility and increasing operational risks. That's the headline coming out of it. So let's deal with the details of what we are seeing within this report. The chair of the European Banking Authority, Jose Manuel Campa, joins us around the table. Good morning.
Morning.
Nice to see you again. This is quite. I'm looking at the European banks and how they've done this year. Up by, 57% in terms of the overall performance that we've seen in terms of their share prices. You are, though, kind of in your report this morning talking about the risks, and you are a regulator, so you understandably kind of want to do this, but the language is quite strong. EU, EEA banks remain highly vulnerable to external shocks due to ongoing uncertainty is the line that really sort of stands out to me this morning. I'm a shareholder in a European bank. How worried should I be by what I read here?
Well, if you're a shareholder of a European bank, you're also a European citizen. If you think about the conversation which you were just having about the tensions of the Ukraine war, the fact is that we're in the middle of a war. We are a lot of tensions. There's tensions that have been rising over the last year. So we think that the geopolitical context is very difficult. And that geopolitical context somehow will permeate into the economy if risks materialize. And banks are cyclical industries. They will be exposed to that. So although the overall performance has been really good in the market, and not just in the stock market, also on profitability, on levels of capital, liquidity, low, non-performing loans, that's all looking very good, and that's great. Risks are there, and we need to be conscious.
But do you think shareholders are underestimating that risk?
Well, I'm not sure, because I think what shareholders have been doing is repricing. A market that has been very, very poorly performing for many, many years. The banks, the European banks, were systemically undervalued on their equity prices relative to other Western banks, Anglo-Saxon banks. So a lot of that has been repricing, catching up, I would call it. Well, I think it's also good, the economic outlook for Europe right now. Unemployment is good. Growth is not great, but it's not negative. We're not in a recession. Again, there's cyclical businesses. So that's good. So I think that's all good. But nevertheless, and this is a risk assessment report, the geopolitical risk is the area where I think we need to focus. And that can materialize in many different ways into the bank's balance sheets.
Jose, good morning. Is there any particular worry about the German banking sector with all of this in mind? We heard from the German business lobby talking about the economy being in free fall. They're trying to persuade the German government to do more. Germany is trying to do a lot fiscally. Is there a particular concern when it comes to the impact of the conflict in Ukraine, the geopolitical realignment we've seen as a result of that is weighing heavily on Germany?
Right. As I said, the geopolitical risk can filter into the economy in different ways. Our focus has been, we think this is more likely to focus more on those sectors that are more exposed to international trade, international activity. The German economy is very exposed to that activity. I think that's the link that is there, and it's reasonable to think that it will be affected. I don't think that's a vulnerability for the stability of the system, but they're more exposed. Also, if I may, from the previous 2 or 3 years, we've also seen increases in commercial real estate exposures that are becoming what we call early non-performance, stage 2. And that has happened a lot in Germany as well.
I wonder, last time you came in, Jose, we were talking about areas where you wanted more transparency, private markets and the relationship between private markets and the banking sector. That's clearly an area you wanted more transparency. SRTs, significant risk transfers, you wanted to see more transparency there. Are you getting the transparency you need on both of those fronts to assess the risks from those dynamics into the banking sector?
Yeah, if I may, on those 2 examples that you put, the situation is quite different. I think on SRTs, I'm positive. I think we're making a lot of progress. There's also a proposal from the Commission on enhancing the securitization market in Europe, which I think will go in the right direction, and the co-legislators hopefully will approve that soon. So that's good signs. On the other part, I think we still have a big black hole, and I think that we need to continue to focus there in getting more information, better understanding of what the different linkages are, where leverage may be, where liquidity mismatch may be within the non-bank private credit sector that continues to grow, by the way. So that's an area of focus.
Bank of England's doing stress tests or trying to kind of talk to the industry about this. Do you welcome that? Do you think that there should be more of that? Are you thinking about doing something similar?
Yeah, absolutely. I think it's a very good exercise. When you made stress tests also, I take it that you said to the non-banks.
Yes.
Yes, absolutely. I think that we need to have more information on how that part of the financial sector. That's been growing a lot. And I'm not saying that it's all solely potentially dangerous.
Yeah.
I'm saying it's just been growing and we don't know.
But do you think you should do... They're trying to launch... It's a voluntary process. It's not something that is formalised in the same way as stress testing in the banking sector. But do you think you need to be doing more?
I mean, I think both at the global level, the Financial Stability Board is working on this.
Yeah.
At the European level, the European Systemic Risk Board, and we're working with them in trying to understand a mapping of how that overall sector is working, what the interlinkages are, and where potential vulnerabilities may be there. And I think that's an area for us of focus and that we will continue to work in the coming years.
Thinking about risks, I wonder what your take is on, well, do you think that European banks have become more interested in stable coins? And if so, what is the reason there? Because I've heard lots of suggestions, Jose, about how this actually does link into geopolitics, and it links into the way that the dollar perhaps is becoming dominant after the Genius Act in the dollar stablecoin space, therefore, and that European banks have something to fear from that and therefore are keener on a European version.
Yeah, no, I think there's big interest. I would distinguish between stable coins. I would also distinguish between technology, crypto technology being used in the financial sector, because you also have tokenized deposits, you have different ways in which the technology can be filtered. But we have seen announcements of projects by banks. Last week there was an announcement by 10 banks, 10 large banks in Europe, putting forward a project to build a stable currency in Europe. We have been seeing interest. I would say that take-up still is relatively slow.
Yes.
But over the long term, I think it's important to follow that.
Is that because, though, of worries about what the Trump administration could do in terms of access to payment systems, or worries about dollar dominance in stablecoins?
Yeah, I think the area that's concerning for us is, first of all, we see that there is a difference in approach from the European to the Americans, particularly in two areas. Europe has a digital euro project, which they're spending a lot of time. In the US, they have made clear that they don't want to develop a CBDC, a central bank digital currency. Second part, as you said, the US is putting a lot of emphasis on the innovation aspect that the industry can bring. We tend to be more concerned about the risks that the industry may bring. So those are two big differences.
OK, thank you so much for joining us. Really good to get your perspective on a host of risks, I guess, pertaining to the banking sector. Jose Manuel Campa, Chair of the European Banking Authority. Speaking of the banking sector, Bloomberg will have an interview with the Bank of America CEO, Brian Moynihan. That's at 9:15 London time. So that's certainly worth staying with us for.
You want to stay with us regardless, because we've got some great conversations coming up on this programme as well. In a moment, we're going to take you to Dusseldorf. Armin Papperger is the CEO of the German defence giant Rheinmetall. Oliver Crook will be in conversation with him very shortly. That's coming up. This is Bloomberg.
Welcome back. This is the opening trade, 8:46 here in London. Over to Germany now, and Germany has ramped up defence spending to 108 billion euros, the most since the end of the Cold War. The move aims to bolster the armed forces and equip Germany to tackle a growing threat from Russia.
Peace deal or ceasefire, anyway, both things are strongly connected. But I think still it calls for action in Europe to actually ramp up, fill up stockpiles. And here I see still defense spending. I mean, the plans are there, that the demand is structurally high, which has been confirmed in a couple of meetings I had with German politicians. So we expect that the next 10 to 15 years, defense spending will continue.
That was the Hensoldt CEO, Oliver Dure, speaking to us a little bit earlier on this week. Well, our very own Oliver Crook is in Dusseldorf today with another company that expects to benefit from Germany's increased spending. Oliver.
That's right, Anna. With all that spending in the German government in focus into the sort of military, we heard there from Hensoldt. We're happy to hear now from Rheinmetall, the CEO, Armin Papperger. Thank you so much for joining us here at your headquarters in Düsseldorf. I'd like to begin with the sort of flurry of diplomatic activity that's currently happening around Ukraine. If there is, in fact, a peace deal, first, what do you think the prospects of a peace deal are? And second, what does it change for Rheinmetall if, in, say, 2 weeks, there is no longer a war?
I wish that peace is coming in Ukraine, because the Ukrainian people, but also the Russians, are suffering a lot in this area. War is really crazy. But I believe with all the discussions I hear, I'm not a politician and I have not the final informations about that, but what I hear from the press is it will be hard to that we get peace.
And what does it change for Rheinmetall if there were to be a peace agreement?
Look, we are in negotiations with all the European and all the NATO partners at the moment with contracts. We signed a lot of contracts, and we see absolutely zero impact about that, because the Ukrainian business is a business, but it's still a small business in comparison to the rest of NATO. If you see what we do, is there is a possibility to make 1 billion with Ukraine, but that's it, and the rest is growing much faster.
And also this discussion around Russian assets has been a very active one. Do you think that there will be a deal to touch that and get a reparations loans? And again, if they were to monetize those assets, what kind of difference would that make for Rheinmetall, for your business?
This is a political decision. Yeah, it's very hard for industry to say something about that. But if there are reparation payments from the Russian side, or if Europe can use the money, there will be an accelerator. It will not slow down, it will accelerate.
We've heard a lot from politicians really since the beginning of the war, and we've heard a lot about this timeline that Europe needs to be prepared to defend itself basically in the next 4 years. Is Europe a continent that will be prepared to defend itself in the next 4 years, given what you've been seeing in terms of the order books and industry? Are they matching that need?
We are in a good way, on a very good way. And you see what Rheinmetall is doing at the moment. We are building up 13 factories, new factories, or doubling or tripling the capacity of the factories. We are investing a lot of money, and we are able really to grow up the numbers. If it is ammunition, if it is vehicles, we prepare. Europe industry is prepared. And the governments are also prepared because they spend the budget.
And in terms of assessing kind of soberly what the Russians, for example, are good at doing, what Germany and the Europeans are good at doing, what is Russia better at than Europe? What is Rheinmetall and Europe better at than Russia? And kind of how do you close that gap when you think about kind of the military capabilities that are required?
In some areas, I think the Europeans or the NATO is much better prepared on technology-wise than Russia. Russia is producing higher numbers. But if NATO and if the European countries are working together, we are very strong. And what we should do is prepare ourselves that nobody won't attack us.
And I think that in order to achieve that, obviously, the scale of ambition has to be very large. I would say that Rheinmetall seems to have much higher ambitions than many of the other CEOs that I speak to within the industry. You're building the factories. A lot of other CEOs are a little bit more cautious in their approach. What accounts for that difference in Rheinmetall trying to take advantage of that once-in-a-generation opportunity? Why do you think you are prepared to do that in a way that your competitors are not?
We believe the demand is high for the next 10, 15 years. And I'm not responsible for other companies, so I will speak not about other companies, but we believe that the way that we are doing that is absolutely the right way. We enable the governments, that they can react very fast. We create capacities here in Europe, which are also able to produce a level of ammunition, of tanks, of electronics, which is on a war level.
And you want to close a lot of the gaps that exist in the European system. You've gone into new territory to do that. Where else do you see gaps, do you think, that Rheinmetall could fill? We've talked about satellites, for example, very recently.
Yeah, we started as an ammunition company. We stepped into platforms. Now we are not only on land platforms, we want to go onto the naval platforms. But everything, the glue between that stuff is digitization. And for digitization, you need also satellites. That is that we go into the satellite business, but we also go in new ammunition types like drones. And we produce this year for 120 to 130 million euro drones. So we are also a huge drone, or one of the biggest drone producers in Europe. But nobody takes care about that because the figures are still too small.
And thinking about the sort of the future and the degree of growth that you were sort of preparing for, there are always growing pains when you are growing at that rate. Where are the growing pains right now? Where are the areas of concern that you need to figure out? Is it labor, getting the kind of people to specialize in all of the things you're moving into?
We get a lot of people. So we have, this year we will have about 300,000 people who want to join Rheinmetall, which is great. And we can pick out 10,000 people because we hire about 10,000 people per year. The biggest problem that we see, don't call it problem, the biggest issue is that we bring the supply chain really under control, that the supply chain can grow like we grow.
And thinking about the supply chain, because that's the lesson we've learned during the pandemic, and we keep learning every couple of quarters. One of the issues in the supply chains that we've had a lot of attention on recently, raw materials, critical raw materials, rare earth metals. How close are you to being completely secure in that domain? How much of that of your time does that occupy?
We check it weekly.
Yeah.
I get a risk report every week on rare earths, on different materials, and we have to check it. And at the moment, we have it under control. Is that forever? I think for the next 12 months, everything is fine. For other materials like linters, we are fine for the next 4 years. So therefore, we do a lot.
And thinking about that risk assessment, do you think about potentially relationships souring with, for example, China, where a lot of raw materials come from? How insulated are you about that? How often do you think about China and its role within your supply chain, and how are you adapting it?
The Chinese part of our defense materials that we have is less than 1%. So it's very small. And China is, at the moment, in different areas, a very reliable partner. In other areas, like rare earths, as I said, they made a stop. But we can find other sources, so it's possible.
And I'd like for you to sketch a vision for us of this ambition, this massive ambition that you have for Rheinmetall, what this business looks like in 5 to 10 years from now, and potentially also how important you think that that is to European sovereignty, because we've learned what dependencies in Europe look like and the consequence that can be.
The European politicians are very clear about that. We must be a partner of the United States. At the moment, we are not a partner because we invested nothing over the last 30 years. And as I always said, President Trump is absolutely right to say, okay, the Europeans has to invest more. Now they invest. And with that investments, we become a partner, and then we can create also more technologies here in Europe.
And then one final question about the SAFE program within Europe. I mean, there's a lot of discussion that happens in Brussels. Very rarely does it turn into actionable programs. SAFE is one of those programs. It was oversubscribed. How important do you think would it be to get a SAFE 2 program, for example, for the Europeans to push that through? And how much of a difference would that make in satisfying precisely the ambitions that these politicians are talking about?
The SAFE program is a perfect program. SAFE and ASAP. I believe that ASAP 2 would be also very important with the direct investments to the industry. But SAFE is very good for the governments. And the governments now, especially also in the Eastern European side, but all the other Europeans also. Germany is not using it. But it's very important for them really to have safe investments in this area. Great program that the European Union started.
Well, Armin Papperger, thank you so much for your time and welcoming us here in your headquarters in Düsseldorf. That is the CEO of Rheinmetall there, with sketching out his ambitions, not just for the business, but also European defense further out for the next 5, 10, 20 years.
Oliver, thank you very much indeed. Fascinating conversation, particularly in the light of the news we've learned this morning about the US urging Europeans to oppose this EU plan to use frozen Russian assets to continue to fund the war in Ukraine. That obviously a huge geopolitical story that is developing right now.
Yes, and we'll continue to watch German politics with that in mind, with his trip to see the Belgians today in mind, and also what happens domestically in Germany. Will the situation that we just heard described there on German industrial spending and defence spending come to pass based on the politics?
You're going to want to stay tuned. Brian Moynihan is sitting just over there. He's going to be on the pulse very, very soon. Bank of America coming up next with Francine on the pulse. The week's nearly over. Not just yet, though. Plenty still to come. This is Bloomberg.